How can an asset that the world is extremely short of lose 35% of its value in just 24 hours? This is the question that every investor should be asking after the events of Friday, January 30th, 2026. If you look at the fundamentals, silver should be the most expensive commodity on the planet. We are currently in the middle of a massive industrial squeeze. Artificial intelligence data centers require miles of silver-coated wiring to handle high-speed data transfer. Solar panel production has hit a new record high, with silver being an irreplaceable component for conductivity. Electric vehicle manufacturers are struggling to find enough silver for their advanced battery management systems. According to the Silver Institute, the global supply deficit has reached an accumulated 1 billion ounces over the last 5 years. The math is simple. Demand is high. Supply is low. In any rational economic system, the price should go up. But on Friday morning, the silver market stopped being rational and started being predatory. The price of silver opened the day at $120 an ounce. By the time the closing bell rang in New York, it was trading at $78. $3 trillion in market capitalization evaporated into thin air. If you read the headlines from CNBC or the Wall Street Journal, they will tell you this was a reaction to the appointment of Kevin Warsh as the next chair of the Federal Reserve. They will say the market is anticipating a stronger dollar and higher interest rates. But that is the corporate narrative. It is the bedtime story they tell you to keep you from realizing that you just participated in a giant wealth transfer. The Kevin Warsh announcement was not the cause of the crash. It was the cover story. The real work was done behind the scenes, in the high-speed fiber optic cables of the exchanges in Chicago and London. What we witnessed on January 30th was not a market correction. It was a controlled liquidation. It was a moment where the people who run the casino decided that the players were winning too much, and it was time to change the rules of the game mid-hand. To understand how they did it, you have to look past the charts and into the plumbing of the financial system. You have to understand that when you buy silver on a computer screen, you are not buying a metal. You are buying a promise. And on Friday, those promises were used as a weapon against the very people who held them. Every market has a safety valve. In the silver market, that valve is controlled by the Chicago Mercantile Exchange, also known as the CME Group. On Friday morning, as silver was already under pressure from the Fed news, the CME decided to turn the valve. They aggressively raised the margin requirements for silver futures contracts. To the average person, this sounds like a technical adjustment. To a professional trader, it is a death sentence. When you trade with leverage, you only put down a small percentage of the total value of the trade. If you have $10,000 in your account, you might be controlling $100,000 worth of silver. The exchange allows this as long as you maintain a certain amount of cash in your account as collateral. By raising the margin requirements, the CME essentially told every trader that they needed to double or triple their cash on hand immediately just to keep their existing positions open. If a trader did not have an extra $50,000 sitting in their account on a Friday morning, the exchange's computer systems automatically sold their silver at whatever price was available. This is known as a forced liquidation. And when thousands of these liquidations happen at the same time, it creates a waterfall effect. The selling triggers a price drop. The price drop triggers more margin calls. The margin calls trigger more selling. According to data from the CME itself, this was one of the most aggressive margin hikes in the history of the exchange. They did not do this to protect the market. They did it to flush out the leveraged long positions. They knew exactly where the stop-loss orders were sitting. They could see the entire board. While the retail investors were being liquidated, the big bullion banks were on the other side of the trade. J.P. Morgan, which has historically held one of the largest short positions in silver, reportedly closed out their shorts at the literal bottom of the crash on Friday. While the small traders were losing their life savings because they could not meet a margin call, the largest bank in America was locking in billions of dollars in profit. This was not an accident. This was a surgical strike. The CME raised the cost of business at the exact moment it would cause the most damage to the public and the most benefit to the banks. This is how the plumbing works. The exchange provides the leverage to lure you in, and then they raise the margin to wipe you out when it suits their biggest clients. It is a legal form of highway robbery, and it happens every time a commodity threatens to break the banks. In the world of high finance, a single technical failure is a problem. 2 technical failures at the same time is a coincidence. 3 technical failures during a record-breaking market crash is a strategy. On Friday, January 30th, while silver was in freefall, the London Metal Exchange, or the LME, suddenly went offline. This is the second most important exchange for silver in the world. Their official statement claimed it was a connectivity issue with their primary data center. At the exact same time, HSBC, which is the second largest short holder of silver in the London market, reported that their online trading platforms were experiencing technical difficulties. Customers were unable to log in to manage their accounts. They could see the price crashing on external websites, but they were powerless to act on their own holdings. This meant that for several hours during the peak of the crash, the exit doors were locked. If you were a retail trader trying to close your position to save what was left of your capital, you were stuck. You were forced to watch your account balance bleed towards zero, while the support desk told you they were working on the problem. Meanwhile, the institutional high-frequency trading algorithms were still perfectly connected. They were trading millions of ounces of paper silver per second, driving the price lower and lower. This is a recurring theme in the silver market. Whenever the price moves too fast in a direction that hurts the banks, the systems coincidentally fail. We saw it in the nickel market in 2022, when the LME actually canceled thousands of trades to save a Chinese billionaire from losing money. We saw it again on Friday with silver. According to reports from traders on the ground, the liquidity in the silver market vanished during these glitches. There were no buyers, only forced sellers. This allowed the price to drop $20 in a matter of minutes. If this happened in any other industry, there would be an immediate criminal investigation. If a casino locked its doors and refused to let people cash out while the building was on fire, people would go to jail. But in the silver market, it is just called a technical glitch. It is part of the cost of doing business in a rigged system. By the time the systems came back online, the damage was done. The banks had covered their positions, the retail traders had been wiped out, and the price was sitting at a new, lower floor. The trap had been sprung, the prey had been consumed, and the predators were already moving on to the next target. One of the most revealing parts of the January 30th crash was not what happened in Chicago, but what was happening in Shanghai. While the paper price in the West was crashing to $78, the physical price in the East was telling a completely different story. On the Shanghai Gold Exchange, silver was trading at a premium of nearly $40 over the New York price. This is an unprecedented gap. In a normal, healthy market, the price of a commodity should be roughly the same all over the world. If silver is cheap in Chicago and expensive in Shanghai, traders should buy it in Chicago and ship it to Shanghai until the prices balance out. But that is not happening. And the reason is simple. There is no physical silver available at the $78 price. If you call a major silver wholesaler in London or New York today and ask for 10 million ounces of physical silver at the current screen price, they will laugh at you. They will tell you that the wait time is 3 months. They will tell you that you have to pay a massive premium over the spot price. The $78 price is a fiction. It is a price for paper contracts that represent silver, not the silver itself. It is a number on a screen that is used to settle bets between gamblers. It has almost nothing to do with the actual metal that is needed by the solar and AI industries. The East, particularly China and India, has figured this out. They have been aggressively draining the Western vaults for years. They are not buying paper contracts on the CME. They are buying physical bars and moving them into their own private vaults. According to data from the Shanghai Gold Exchange, their physical delivery volumes are at an all-time high. While Western investors are being scared into selling their silver by a 35% crash, the Chinese are more than happy to buy every ounce they can get at these artificially low prices. We are witnessing a global arbitrage where the West is selling its real wealth for paper promises, and the East is buying that wealth for a massive discount. The crash on Friday was a gift to the Chinese industrial complex. It allowed them to secure the raw materials for their green energy dominance at a price that is far below the cost of production. The disconnect between the West and the East is a sign that the global silver market is breaking in two. There is the paper silver market in Chicago, which is rigged, manipulated, and crashing. And then there is the physical silver market in Shanghai, which is expensive, scarce, and booming. Eventually, the physical reality will win, but until then, the banks in the West will continue to use the paper market to hide the truth. To find the motive for any crime, you have to follow the money. And in the case of the silver crash on January 30th, 2026, the money leads directly to a set of regulations called Basel III. Basel III is an international framework for banking supervision. Its goal is to make sure banks have enough high-quality assets to survive a financial crisis. For years, the big bullion banks like JP Morgan and HSBC have been allowed to trade silver that they do not actually have. This is called unallocated silver. It is essentially a giant IOU system. But under the final phase of Basel III, which is being implemented right now in early 2026, these unallocated paper positions are being treated as a major risk. The regulators are telling the banks that they can no longer count these paper promises as real assets. The banks are being forced to either buy the physical silver to back up their trades or close their positions entirely. This put the bullion banks in a desperate situation. They were sitting on massive short positions, meaning they had bet that the price of silver would stay low. If they tried to close those positions while silver was at $120, they would have lost tens of billions of dollars. They needed the price to drop so they could exit their short bets without going bankrupt. They needed a liquidation event. The January 30th crash provided that event. By engineering a sudden, violent drop in the price, the banks were able to buy back their short contracts at $78 instead of $120. They saved themselves billions of dollars at the expense of every retail investor who was long silver. This was the ultimate exit strategy. The banks used the Kevin Warsh announcement as the perfect political cover to trigger the algorithms and the margin hikes. They cleared their balance sheets just in time to meet the Basel III requirements. According to market analysts, the amount of short covering that happened on Friday was massive. The banks have successfully shifted their risk onto the public. They have cleaned up their mess, and they used your retirement account to pay for it. This is why the timing of the crash was so perfect. It was not a random market movement. It was a regulatory necessity for the survival of the banking system. The banks knew they could not afford to let silver go to $200 while they were still short. They had to break the market to save themselves. Now that the banks have closed their shorts and moved to the long side, the suppression of the silver price may finally be coming to an end. But for the thousands of traders who were wiped out on Friday, that news comes too late. The banks have already won this round, and they did it by changing the rules of the game just as the clock was running out. Despite the 35% crash, the physical reality of silver has not changed. In fact, it has become even more bullish. As we move further into 2026, the demand for silver from the technology sector is reaching a boiling point. The expansion of AI data centers is not slowing down. Every server rack that is installed requires significant amounts of silver for electrical contacts and high-speed connections. In the solar industry, the transition to N-type cells has increased the amount of silver required per panel by nearly 30%. The world is building more solar power today than at any point in history, and every single panel is a permanent drain on the silver supply. Unlike gold, which is mostly stored in vaults, silver is consumed. It is used in industrial processes, where it is often too expensive to recycle. According to projections for 2026, the industrial demand for silver will exceed total mine production for the 6th year in a row. The mines in Mexico and Peru are struggling with declining ore grades and rising labor costs. There are no major new silver mines coming online this year. This is the fundamental reality that the paper traders in Chicago are trying to ignore. You can crash the price of a paper contract, but you cannot crash the demand for electricity. You can wipe out a retail trader's account, but you cannot wipe out the need for silver in a Tesla battery. The tech giants are starting to realize that the banking system is no longer a reliable source for raw materials. There are rumors circulating in Silicon Valley that several major tech companies are looking to bypass the COMEX entirely and sign direct offtake agreements with mining companies. If this happens, the paper market becomes irrelevant. If the real buyers of silver stop looking at the Chicago price and start negotiating directly with the producers, the ability of the banks to manipulate the market will vanish. The crash on Friday was a desperate attempt to reset the system, but it did nothing to fix the supply problem. If anything, it made it worse. By driving the price down, the banks have discouraged new investment in silver mining. Why would a mining company spend $1 billion to build a new mine when the price can be crashed by 35% in a single day? The banks are eating their own future. They are keeping the price low to save their balance sheets, but in doing so, they are ensuring that the eventual physical shortage will be even more catastrophic. The silver market is a coiled spring, and the harder the banks push it down, the more violent the eventual explosion will be. The silver crash of January 30th, 2026 will go down in history as one of the most blatant examples of market manipulation in the 21st century. It was a masterclass in how the house always wins. But it was also a warning. It was a warning that the financial system as we know it is reaching its breaking point. When the exchanges have to fail, the banks have to engineer crashes, and the regulators have to ignore the rules just to keep the system standing, you know the end is near. The people who lost money on Friday were the ones who trusted the system. They trusted that the price on the screen was real. They trusted that their brokerage app would stay online. They trusted that the market was a fair place, where supply and demand determined the value of an asset. The people who won on Friday were the ones who understood that the system is a machine designed to extract wealth from the many and give it to the few. They were the ones who held physical silver in their own possession, away from the margin calls and the technical glitches. To a physical holder, the price drop was not a disaster. It was a temporary discount in a rigged market. As we look toward the rest of 2026, the trend is clear. The migration of silver from the west to the east will continue. The industrial deficit will grow. And the banks will continue to use every trick in their book to hide the truth. But you cannot hide the truth forever. Eventually, the silver will run out. Eventually, the tech companies will demand delivery of the metal they have paid for, and the vaults will be empty. On that day, the paper price in Chicago will not matter. The only thing that will matter is who actually has the metal. The lesson from the January crash is simple. Do not play the paper game. Do not use leverage in a market where the house can change the rules at any moment. If you want to own silver, own silver. Do not own a promise from a bank that is desperate to see the price fail. Mainstream media will continue to talk about Kevin Warsh and the stronger dollar. They will continue to provide excuses for the banks. They will tell you that silver is a bad investment and that you should put your money back into the stock market. But stay skeptical. Look at the industrial demand. Look at the Shanghai premiums. Look at the Basel III regulations. The signs are all there for those who are willing to see them. The house always wins in the short term because they own the board. But in the long term, reality always wins. And the reality is that the world is running out of silver, and no amount of paper manipulation can change that fact. The Friday crash was not the end of the silver story. It was just the beginning of the final act. The players have been moved. The pieces have been set. And the real reckoning is still to come. When the music finally stops, make sure you are not the one holding a paper contract in a world that only wants the metal.